Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
And welcome back. Another fine week in the market. Was actually pretty interesting. The Pier 1, I bought that stock. It came up on a scan, and I bought the stock. I was holding on to it for about a week, and I don't know if you saw what happened on Thursday, but you might want to take a look at that. It's hilarious. It's done extremely well. In one day, this is what's crazy about this. One day, the stock goes up over 32% in a day. In one day. So, by the way, that is a really aggressive strategy that I use. That's not something I do with a lot of money. In fact, I think I put less than, it was only about 1%, because after all, the stock was under $10, and those stocks that are under $10, they don't have to fluctuate a lot for you to be up or down 30 or 40%. Only about $3 or $4 a share, actually. So we're going to be talking about that, how I identified that stock, specifically how I identified that stock and other stocks like it. It's been a very good quarter. I don't think you take a look at AMD and a lot of the other names out there. The stocks are moving. I mean, really fast. It's about time. It's been a couple of years since that particular style has been effective. And it's very cyclical like that. It's called momentum investing. Very cyclical. So is value, by the way. Value is very cyclical. Value is actually, the last 3 years, has been knocking the cover off the ball. But we're going to be talking about the momentum thing, how I identified Pier 1 and how you can identify stocks like that. And basically, it's just putting yourself in a position to get lucky. That's what you're doing. You're putting yourself in a position to get lucky. You do what I'm doing long enough, and you'll find another Pier 1 or other stocks that do similar things like that. And there have been a lot of them through the years, but as a percentage of the total, it's not a high percentage. A very small percentage of your stocks will go on to make a large proportion of your profit. And that's just how it goes, even with the value stuff. I've got another value model I'm rolling out. I really like this one a lot. I've gotten my dividend model has done very well, and that's actually the best performer over the past 3 years. You go back over long time periods, the momentum is actually still ahead, even though the past 3 years it's lagged. And that's kind of how that works. Those are the two major styles, incidentally. You've got momentum that somebody uses price movement in some way, shape, or form. And then you have value, people who are looking at stocks trying to get the best values. The dividend's one of the easier ways of identifying value because, it's cash. I buy the stock, how much am I going to get? That's an easy one. That's actually why it's so popular. And we're also going to, we're going to talk about those things. The first part of the seminar is at 6:30. And actually, I forgot what date it is. I'll have to log into my account here while I'm on the radio. That's funny. And look up the dates. First couple of weeks in January, I'm sure. But we're going to be talking the first part of the seminar. It's going to start at 6:30 about the momentum thing. How do you identify the Pier 1s going forward? How do you identify those stocks that just rocket, stocks that scream? There's when the market conditions are conducive. When the market conditions are conducive, you want to know how to do that. It's fun. You may actually, I take that back. You might not. You might find out once you have gone to the seminar and you've learned a little bit more about it. You might find out, yeah, that's fun, that's nice, it sounds good, but I don't have time, and I really, quite frankly, I just don't have interest in it. Great. Then we've succeeded in that seminar, because if you look at it, you'll understand it, and you say, yeah, I don't think that's for me. That's fantastic. A big part of being successful in investing is finding those strategies that suit your personality. That's a big part of it. And that's something you never hear people talk about, mainly because financial planners don't manage money, and the portfolio managers who manage money the way it's comfortable for them. So they don't understand somebody who doesn't feel as comfortable with what they're doing as they do, okay? Because that's not their job. They don't interact with their investors. They don't talk to them. So and that's where we are a lot different, because I have to talk to you. It's actually law. I have to try to find the strategy, put you in the strategies that I like. And there's nothing off limits, by the way. I think it's kind of funny when people come in and they don't really understand that I can invest in anything. I am not an employee of a firm. I'm an employee of my clients. I work for you, not for a firm. The firm is my firm, and we work for you. So we're going to try to match you up with the portfolios I think that you have the best chance of being successful with. And anyway, that seminar, I got to find out where the I know it's at the corporate college, and I think, hang on a minute, I'll just go right to it. There we go. Bullington Capital. That's funny. I come up pretty quickly when you type it in on Google. Then you click on seminars, and yes, it's the 12th. That's a Thursday evening. So the first part, individual stock talk, we've done it a couple of times. Last time I didn't do that, but we're going to bring this back regularly now. Individual stock talk. That's how to identify those companies like Pier 1. Those things that are, I like to call them screamers because they're screaming. And sometimes they might make you scream. When you buy a stock that drops 30 or 40% the day after you bought it, you might be screaming. When you buy a stock that goes up 30 or 40%, you're screaming for a different reason, and it's a different type of scream. So that's what I like to call them, finding the screamers. I love to find the screamers, and it's a blast. It hasn't worked, I'm telling you. If the market conditions are not conducive, and I'm going to show you how to determine whether the conditions are conducive or not, but if they're not conducive, you have to dial your risk back. You have to take a lot less risk. And then when the market conditions are conducive, you can go ahead and take the normal amount of risk you would take in a bull market, which we are definitely in right now. We're in a bull market. The second half of the seminar, by the way, which starts at 7:30, and it's only going to go for about 45 minutes, by the way. And I know everybody that knows me goes, yeah, right. I do have a tendency to talk a little bit. But I'm only going to talk for about 45 minutes. I'll open up for questions. That's going to begin at 7:30. And all this, you can go to my website, Bullington Capital Management, sign up online, no cost, no risk. We've got 80 seats remaining. So anyway, just go there and check it out. We're going to be talking about the new president. I've been reading voraciously since he was elected, especially since I didn't anticipate that he was going to be elected. And I didn't bother. And now I've had to catch up. And you know what? I have to say, there are some risks there, but there are also some really big opportunities. Some things that I'm very impressed by some of the people who have decided to work with him. And I didn't think they would. I mean, the public opinion, swayed me. And I didn't think the individuals who are taking some of the cabinet positions would actually accept them. And they are. So that's very interesting. That opens up some opportunities if you know how to identify them. And that's what we're going to be talking about. So that starts at 7:30. And I did have some people ask if I can record those seminars and send them in. And actually, there's no easy way to do that. There's no easy way to record the seminar. I'm going to give it a shot. I'm going to take a recording device. By the way, it cost me $350. Somebody goes above and beyond for their clients. $350, and that was for one of the. I was looking. It was on sale. There's these microphones that you can get. I don't know how. I do not know if it's going to work. It converts it to an MP3 file. People bring these to concerts to record. I got the Guitar Center, by the way, but I wish they would go public. That would be interesting. Maybe they are, and I just don't know it. I'll have to look that up now that I said that. Anyway, I've got this microphone, so maybe I can put that up. I'm not sure it's all that beneficial, though. The sound without visuals may not be as effective, but I'll give it a shot. We'll put it up there. And at some point in time, maybe we'll even start to video portions of the seminars. I don't know. That's a lot of work, folks. I don't know if you've ever tried to shoot or edit video. I'd hire somebody to come and do it because that's how much effort it took. And she's on staff now. You can go to my website. It's Melissa Arcuri. Melissa King's the head of the administrative, and she's awesome. Gary does all the trading, and he's awesome. You got to have nerves of steel to do that, by the way, because if you make a mistake, we get to eat it. And when you are dealing in millions of dollars, one little mistake can cost you big time. So you've got to have very calm and steady nerves if you're going to do that job. And me, I actually just develop the strategies, deal with some of the administrative tasks. I interact directly with all of our clients, and it's fun. I really like it. But anyway, I always get off the topics. So first part of the workshop is going to be individual stock talk. How do you identify those companies? We do have the other work, the website, Look Out for the Bull. By that point in time, it should probably be up. And that's the website where I'm going to run the scans, the same scan I found Pier 1 with, the same scan I find all these stocks with. By the way, in most markets, you're only going to make money on about half of your trades if you average it across a long time period. If you look over a short time period and the market is not conducive, you're probably going to lose money on 80% of your trades. Then you're in a bull market, and I can tell you right now, 8 out of 10 stocks I purchased over the past month and a half are all up. So it really is not what you're doing. It's actually the market that actually governs what your winning percentage is going to be. How strong the market is will typically lift up your batting averages pretty significantly. And in fact, one of the clues that the market's about to turn is when you keep getting stopped out of stocks quickly. That gives you an idea that, hey, maybe the market's not as strong as it looks on the outside. So all those types of things we'll be taking a look at. But then the second half of the seminar, we're really going to talk about the investing part. Because there are two schools of thought when it comes to investing. There are people who utilize price movement, and a lot of people like to call them momentum investors. Some people like to look at charts, and they do it in a number of different ways. A lot of them aren't very good, by the way, but they are helpful if you use them in the right context. And then, on the other side of the equation, you have the value guys, and I like to do a little bit of both, which makes me extremely strange. There are a lot of hybrid funds out there, by the way, hybrid mutual funds that do that. Most of the time, people are not extremely impressed with them because they're rarely in the top 10% for any 1 year. You take a look, because over a 1 year time period, the people that are in the top 10% of people are a lot of people that just got lucky. It's exactly what happens. They invested in biotech, 2 years ago. Biotech had this huge run. All the stocks that were overweight biotech, all the funds that were overweight in biotech had extremely good track records. It made their 1, 3, and 5 year track records look awesome because the 1 year was so good. It lifted the averages in the 3 and the 5. And people bought that, and this year they've kind of really stunk up the joint. That's exactly what happens. That's what you have to be on guard against when you're looking at mutual funds. I think picking mutual funds is harder than picking stocks by far. By far, because you have no idea what that fund manager is doing. That fund manager happens to get a divorce. You can bet that their judgment is going to be off a little bit when they're making those decisions. That's the reality, by the way. It's not something I'm making up. That's something I've experienced. Fund manager has emotional distress, and it affects their fund performance. It's just going to happen. They're people too. It's one of the reasons I like math instead of trying to develop feelings or using intellect or judgment. I like math. Math doesn't have emotions. It's hard to mess up emotionally when you're just using math. Does that make sense? So anyway, we're going to be talking about all this stuff. And again, there are two major schools of thought, and I'm constantly building models. It's kind of fun They're all actually pretty similar, by the way. The dividend model that I use, which is probably the most popular one because it's done so well over the past couple of years, that's really popular right now. And a lot of people want to put a whole lot more money in. I'm thinking, okay, yeah, that's fine. But the conditions for momentum that typically accompany a big run in momentum stocks are improving. In fact, they've improved a lot. The performance of that model has improved a lot just in the last few months. Is it going to be another head fake where it starts to go and then it turns around and, craps out again? I don't know. You don't know that until after the fact. That's one of the reasons I like to have the other side of the strategy there too. The value-oriented stuff is not as impacted, not quite as impacted by moves in the market as the momentum stuff is. When the momentum is working, it is, it's like, wow. It can be spectacular. And it's those brief time periods over time. You got to be in there. You got to be in it to win it. You have to have some money allocated to that strategy. Sooner or later, when the conditions are right, it'll start to run. And by the way, the stocks take off before the economy sends you a signal. That's the rub. The stocks will already be up a lot before you get the idea from the economy that, hey, things are pretty good. That's the way it works, because the smart money, like the super smart money, the money that's in all these hedge funds, a lot of hedge funds don't do very well, but the ones that do, those guys are in 6 to 9 months in advance. They have people out into the fields talking to these CEOs of companies. They're talking to the suppliers of those companies. They're generally in pretty early. In fact, the news is pretty negative when the market starts to make its big run. That's one of the things that I really like about this market. People don't believe it. They think it's a mirage. They've seen so many corrections in the past year. By the way, that's normal. The thing that's not normal is that they don't realize that it's normal. I'm like, okay, go back and look. Look at the charts. Look at the S&P. Look at the NASDAQ. Look at the Dow. Look at the transportation index, look at the utility index. A lot of volatility all the time. It's always been that way, always will. And the big moves have had a tendency to come. If you go up and you match the GDP growth, the growth in the economy, to the stock market, what you're going to see is it's not very highly correlated. Now, when we come back, I'm going to tell you what you can do about that. Stay tuned. You're listening to Bill Bullington right here on 1420 The Answer. Be right back.
You used to say, live and let live.
And we're back. Hey, I got this question. If you want a question talked about on my radio program, just email me, bill@bullingtoncapital.com. Or you can go to my website, bullingtoncapital.com. There's a contact button there, and you can type in a little message there and send it. We'll be glad to try to answer those questions on the radio or give an opinion, because a lot of it is just opinion, quite frankly. So I got a question. Somebody heard Kudlow on CNBC saying the U.S. should issue 100-year bonds. I know you've mentioned that in the past. Can you elaborate on how that could impact markets? Yeah, that would actually be very interesting. They have 100-year bonds in some countries around the world now. And basically what people would be doing is locking in an interest rate for 100 years. If the government issued bonds, those are basically promissory notes, a promise for the government to pay interest. In this case, it would be for 100 years. Those don't exist yet, by the way. But if they did, they would pay interest for 100 years. And at the end of the 100 years, they would pay your principal back, the money that you invested. If that were to happen, a 1 or 2% increase in short-term interest rates would cause those bonds to drop in current price by a lot, like dramatically. It's it's pretty. It would be pretty wild to see the swings in those bond prices. Now, to give you an example, let's look at the ETF TLT. ETF symbol TLT. That's the iShares Barclays 20-year Treasury bond fund. So the average maturity of this fund, their treasuries, by the way, is about 25 years. It's about 25 years. Now, interest rates recently went up because bond prices fell. That's actually what happens. When bond price falls, the interest rate goes up. I'll give you a quick, easy example. Let's say you had $100 or $1,000. Let's say it's a $100 bond. They don't really make those very often, but so just bear with me. $100 bond is paying $5. Okay, that's 5%. $100 bond pays $5. Now interest rates go up to 10%. Okay, so somebody getting a 10% bond, that's or a $100 bond, will get $10. Right, makes sense, right? $10 is 10% of $100. So if you've got the bond that's only paying $5 and you want to sell your bond and buy one that's paying $10, who in their right mind is going to give you the $100 that you paid? Nobody that's sane anyway, because they wouldn't. Why would they take your money when you're only getting $5 when they could get a brand new one that's paying $10? Why would they do that? So $5, the money that you're getting is 10%. That's the current interest rate of $50. So you bought a bond for $100 that you're probably going to have to sell for $50 if you need to cash it in. That's how that works. Now, I'm going to put a video up on that almost immediately. It'll be up within the next 2 weeks on my website, actually by the end of next week. We'll put up a video on that explains that process again, because I know you're driving around, it's hard. But think about that example, and you'll be able to see that. Anyway, when interest rates go up, bond prices come down. Now, this TLT, they buy long-term government bonds. The yield on it was higher than what you could get on CDs, which is why people were paying $143 a share for that fund, which is now selling for $117 a share. And think about that for a second. In July, that was selling for $143, and now it's selling for $117, even though it's government bonds. See, the price fluctuates. The price is not guaranteed. The principal is guaranteed. On a fund, by the way, your principals, they're investing in bonds who have principal guarantees, but the portfolio manager may be forced to sell some of those bonds and lock that loss in. You might be forced into that if they get so many redemptions. That's not supposed to happen, and I understand it doesn't happen very frequently, but the potential is there. So anyway, somebody buying government bonds last year, and I remember on the show, I think it was first quarter, somebody had purchased them, at the beginning of the year and was real happy, was calling in to talk about how happy they were because they, paid around $120. It was up about 10% or so, and they're extremely happy. They were probably happier when it went even further in July, and now they're below where it was when they called into the radio show. So they're giving in, and that's what I was saying. Hey, it can go higher. Markets do illogical things all the time. Get used to it. Got to get used to it. Markets do illogical things all the time. Sooner or later, the being logical actually finds its way back into markets. Don't know when, but sooner or later, people come to their senses. They go, "Oh, hey, wait a minute!" And the prices begin to go back to more in line with where they should be. In fact, they also often have a tendency to go beyond. They overshoot to the negative side, so then they'll go below where they should be. And for young people, this is really hard. It's hard for them. They really think that the world is supposed to work like they think it should, like it's supposed to work in their textbooks, and it doesn't. And that's a long, hard, tough lesson. Many lessons that have to be learned, but quite frankly, some people never do. Some people never get it, and that's why we do the seminars, because you have to build a framework for investing. You've got to build a set of guidelines, personal guidelines for investing. And I know over the past 2-3 years, I've have clients that I've taken on, and I know for a fact They didn't study any of the material I gave them. And, they thought, when they left the office, they understood most of what I'm saying. This is probably true. Probably understood 80 to 90% of what I said. But if you don't look at the material and you don't retain it, a week later, you're only retaining about half. A month later, you're only retaining about 20%. It's not something you can just walk away from. You actually have to work with it until you actually really get it. And if you're one of my clients out there and you're going, hey, yeah, Bill, I don't really get it anymore, call me. I'll go through it with you. No big deal. This is investing is 95% mental. It's 95% mental. In other words, the psychology involved with being a successful investor is more important than being able to read financial statements. You should be able to get around basics on a financial statement, but you do not have to be an expert at financial statements to be an expert investor. And I know that doesn't make sense, and it probably really upsets a lot of CPAs to hear me talk like that. But the bottom line is it doesn't work that way. There are certain things, yes, you do need to know, and they are financial. You don't need to have a CPA to be a good investor. In fact, that is really overkill. To be a good investor, what you really need to have is a good grasp of the fundamentals, of the basics, the basic stuff. You need to get that. Why does the dividend model work? Well, because these stocks are chosen from some of the biggest, most successful companies that have ever existed on the planet. That's the first thing. They've had an enormous amount of success. Doesn't guarantee that they will continue to have success. It just means they have had success in the past. Secondly, they don't pay dividends unless they're pretty sure they can pay them. They don't write those checks if they're going to bounce. Okay, common sense, right? And what really cracks me up is I had a bunch of a bunch of economics, which is part psychology, by the way, economics professors in college who like to make this incredibly complicated. And then I had others who like to make it really simple, kind of the way they am. And I can see them arguing with each other over what I just said if they were hearing me say this right now. But when you pay the dividend, it's basically because you've had a lot of success as a business and you're returning cash to shareholders. That's typically why stocks that pay dividends work over time. What I'm doing is I'm taking the highest yielding stocks out of each of the major sectors that make up the vast majority of the large company stocks, and I invest in them equally, not market cap weighted. Equally, not market cap weighted. If you don't know what that means, don't worry about it. It doesn't really matter that much. Just know that there's a difference there, and in the long run, it probably makes more common sense. Now that I said that, I'll tell you what, I'll take 5 seconds and explain it. Market cap weighted means you're going to put less money in Microsoft when it's only $1 billion than you will when it's $200 billion. Think about what I just said. You're going to put less money in Microsoft when it's only $1 billion than you would when it was $200 billion. Does that make sense? To penalize it when it's smaller and when it gets too big to move very fast, then you're going to put a lot of money in. That's what market cap weighting is, and that's why I don't like to do that. And I know what the analysts have to say. That's because they manage billion-dollar portfolios. For them, they have no other way of doing it. That's their problem. We're small. We don't have to play by their rules. Eventually, inevitably, that comes home to haunt them. And then a lot of the things that we're doing, you see why we're doing them. Just makes sense. I like to do equal weighted. And I'm going to admit right now, because I know there are some portfolio management firms in the greater Cleveland area, asset managers that manage billions of dollars. And every time they hear me say this, they shudder. Because first of all, they know it's true. Secondly, they know they don't have a choice but to do it the way they're doing it. And we do. It doesn't mean you're going to win all the time. Nobody wins all the time. It just means you given a long enough time period, the edge that you have tends to show up. That edge as a smaller investor tends to show up. But you got to be patient with it. And you have to really understand what you're doing and why you're doing it. If you don't understand what you're doing and why you're doing it, you need to get back with your advisors. If you're reading a mutual fund prospectus trying to decide whether or not you want to invest in it and you can't tell and you are kind of confused by what the manager's saying, go to the next fund. It's not worth it. I don't care what the track record looks like. If you don't understand how it was achieved, the chances of you repeating that performance are nearly zero. And if you do, it's not going to be skill. It's luck. You didn't know what he was doing. How could that be skill? Just common sense, right? The kind of common sense you don't hear on CNBC. 100-year bonds. What's a great thing about that? If we issue 100-year bonds to China and then interest rates go up a couple percent, those 100-year bonds that they bought, they're going to have to hang on to them for 100 years or take a big loss, like a massive loss. And think about that for a second. It's kind of funny that they would issue a 100-year bond. People will buy them. I know they will. I think the Japanese government will buy a lot of them because their bonds don't pay much interest at all. And they'll just never sell them. They'll take that 3 or 4% interest rate and be happy with it. That's it. They won't sell them. But there will be other countries that do buy them, and the price of the bond's going to drop, and they're going to want to sell it. We'll buy it back for less than we issued it for. This is the perfect time to be issuing those. Actually, the perfect time would have been August when bond prices peaked. But this is a good time. That is it's kind of funny. I hope that a lot of the small and emerging market countries don't buy a tremendous number of them, because when interest rates do go up at some point in time, those 100-year bonds are going to drop like rocks, and that could create a lot of problems for those smaller economies. So it's very interesting. It would be good for the United States. It would be very good for the United States, and wouldn't be so good for the people that were buying a lot of those. Personally, I wouldn't buy any of them. Maybe 20 years from now, if you see interest rates at 10, 18% like they were in a money market was paying 18% in the early 80s, then I would buy a 100-year bond. Then I'd be happy. But the only way that gets there, by the way, is if inflation's around 12 or 13%. No, I really don't even have time to explain that today. If somebody wants to remind me, then I'll bring it back up next week. But I did want to mention again, we've got the seminar coming up. We're going to be talking about those risks and opportunities. In the case of the 100-year bond, it's a risk and an opportunity. So not as much risk as there is opportunity for us, for the issuer of the bond. There's more opportunity. There are risks to the people that buy them. If they buy those bonds and rates go up and they have to sell their bonds at losses, or they want to sell their bonds at losses, that could be not a good thing. I don't think China would worry about it. Does it print more money? Which is not good in the super long run, but it's unbelievable how long they've been able to get away with that. So very fascinating. I'm encouraged. I'm very encouraged by what I'm seeing that's developing. Housing starts up. New car sales up. Wages flat. That's not good. Wage growth, by the way, has been lagging GDP growth now for several years in a row. So it'd be nice to see wages go up a little bit, but you can bet when that happens, they will start to raise interest rates. And that could be one of the risks of the presidency over the next 4 years. If they do in fact start raising rates, and I don't think this is one of their areas that I think is kind of funny. The Fed's not controlled by the presidential office, and they can do some things that make it really hard on them. We'll talk about those when we come back from these messages. You're listening to Bill Bullington right here on 1420. Stay tuned.
All our times have come.
Man, oh, wow. Choking. Oh, man. Shouldn't try to drink and eat peanuts between between commercial breaks. Anyway, if you have a question, call or comment, 216-901-0945, 216-901-0945. And I'm really excited. People don't understand. It's been an incredibly long time since you've had an economy that's improving as fast as it is now. By the way, it has nothing to do with politics. It has much more to do with business cycles and technology than anything else. Business cycles and technology. And that's always the way it is. So how do you maximize that? Excuse me. How do you maximize that? Over the next couple of years, I think a combination of the things that we've already been doing at Bullington Capital for a very long time. Dividend models should do it pretty well. Momentum models should actually start to come to the forefront. They should actually start to come to the forefront. So you're going to want to brush up on that. We've held them through, actually, and it was very good. 2009, after the big crash, the 10, 11, 12, 13, very good performance. And then it kind of went to sleep, but 2.5 years, which happens. That happens. That's a normal part of the process. If you've heard me talk about this at all, you've heard this before. And I don't really have control over the market. I can't make it perform the way I want it to. In fact, I don't know when it's going to perform well enough to make the momentum models come to the forefront again and outperform the other ones. I don't know that. I have to always be there. Always have to be there. The amount that you put or you allocate to that strategy is really going to dictate how much fluctuation you're going to see in your account. So I think everybody should have a little bit. But, that's up to the individual. I really don't try to tell them what to do. I just lay out the options, explain them as many times as you need to see it, give you a lot of data on the background. When somebody comes in, we passed out these booklets several times that show each rebalancing, particularly on a high dividend model, and how that works, because it's very important that you're really you want to dig deep. You want to really understand what it is your investment managers are doing. If you understand that, it gives you a big edge. When a correction comes along, you don't panic. You know what's going to happen. You know what I'm going to be doing. It's a big deal. It's like I said, investing's it's primarily an intellectual thing. And it's mostly not intellectual, actually. It's psychological. It's a psychological thing. You don't have to be incredibly bright to be a good investor, which once I found that out, I was really relieved. You don't have to be that smart. That's true. You don't have to be that smart. You do have to have, however, a good understanding of what you're doing. And the strategy has to make sense. It's got to make sense. And then as you get really sophisticated, you begin to realize that, hey, stock markets are really illogical over a 3 or 4 year time period. Never mind over the next 6 months or a year. Stock market can remain completely illogical for years. And that is the hard part. But that's also where the opportunity comes in. What is the market doing that's illogical? What doesn't make sense? How do you know what does make sense? That's why we do the show. That's why we do the seminars. That's why we use those philosophies in the management of our portfolios. And it's just a good thing. It has a tendency to work. I see the phones ringing. We'll have actually sooner or later here. If you'd like to call us at the office, by the way, the number is 330-664-0700. That's my office number. The radio station, we've only got a few minutes left, so I'm going to take this call, and if you want to call back next week, you can. But right now, I'm going to go to Jerry. Jerry, how you doing?
Good morning, William. How you feel about the banking industry as a whole right at the moment?
Well, man, it's unbelievable how far that stuff has gone since the last seminar.
Sure, absolutely. I'm just looking at it now.
I look at the list and I'm like, okay, half of those names have moved up so much so that they are no longer a bargain. And man, if you didn't catch that one, I think you're probably now. I'd say go to the ETF over that model, because the super small companies, their valuations are like 2 and 3 times higher than the bigger companies are. That blows my mind, because, well, it doesn't blow my mind. I understand what's happening there. So there's a little tiny mini bubble in your tiny banks out there. And now your better values are really in the medium size, even some of the larger ones. So I would look at the bank ETF if you're still interested in that. I think that there's a pretty good chance that they do reasonably well, but that rate of change is going to slow down now because it's been so fast and it's gone so far in such a short time period. In the meantime, there are a lot of companies, and Jerry, I know you'll appreciate this for sure. Here's one of the major changes that the market has evolved into over the past, 10 years or so. And it wasn't super fast. It's very subtle. So the stocks will have a tendency to move much farther in a much shorter time period and then correct and give most, if not all, that gain back and then do it again. So if you're looking at over a 12-month time period for relative strength, like is very popular, it's probably too late. You have to look at shorter time periods. I'm even looking at the 1 and 3 month time periods. I'm getting very specific, but the good news is more stocks are coming up on those screens and have come up in years. And that's a very good sign. And also, I made a modification so that I would be able to catch an IPO before it has to stay around long enough to get included in one of the indexes. And that's a big deal. Because, it normally takes the indexes about a year to add a company to their index.
Sure.
So by that time, a big part of the run is already over. And
Right. Well, you said the mid-size BBT. We've talked about that before. You like that at this point?
You know what? I'd actually have to go back and look at the numbers again on that. I don't know. And quite frankly, I won't have time today because I'm coming up near the end of the show.
Sure.
But I can take a look at it over the week. And I'm a big fan, though, of buying. If I'm going to buy a stock that's as a value-oriented investment, I really want to get a good deal on it.
Oh, sure. Of course.
Yeah. So if I'm not, then I'm probably trading it. And typically, I don't like to trade bank stocks because they don't put in those big, like 200, 300, 400% moves inside of a 6 or 8 month time period like Netflix will.
Oh, yeah. Well, that's a crapshoot, I think.
Oh, no. It's not a crapshoot. If you do it the right way, if you use the stuff we're showing at the next seminar, it's not a crapshoot. The bank is a bigger crapshoot.
Really?
Absolutely. You have to control your risk. And if you give up control of the risk, you have nothing. Because that's actually the only thing you have control over is how much risk you're taking.
Right. Well, I'm looking at this financial sector that you had laid out. I mean, as you said, it's very impressive what it's done. I'm wondering from a long-term investment standpoint if it's potential to roll back at all.
Oh yeah, there will be a pullback. There's no doubt about it. I just don't know when it's coming.
When that's going to occur. Yeah.
Yeah.
Yeah. Because you look at the post-election in the last, say, 50 years. I mean, if you have a rally, it's going to come down. It has to.
Oh yeah, markets never move straight up. They never do that. So on the next pullback, maybe, but that's really difficult. It's easier for me rather than having to think and guess and try to use my. Yeah, I'd rather follow a defined set of rules. It's just easier, a lot easier, and it happens to be more effective.
If there would be a rollback, what would you see? Say 10%, 20% of what they're currently. I mean, as a basket.
Okay, asking that question means you were not listening to anything I had just said in the past 15 minutes.
Well, I may not have comprehended it all.
You can't predict the future. Don't even try. It's not worth your time.
Okay.
Give that up. Just give it up. Observe what you can see right now.
Sure.
Okay, so if you're observing what you can see right now, you would be buying the stocks that are moving up the fastest. That's what you can observe. You can measure that. That's measurable.
It's tangible, sure.
Yes. Sure. If you can't measure it, I am not interested. If I have to figure out where something's going to be in the future, count me out.
Yeah.
I don't want to do that.
That is a crapshoot.
It is. And no value investor will actually make a projection. They just don't do it. The only people that make projections are the newspapers because they know that's what you want to hear and that's what will get your attention. And then you get to see their ads.
Yeah.
Okay. But
that's good advice, really.
But the KBE is really if you wanted to have overweight the banks, I would just use the KBE. It's a bank ETF, and some of the bigger names in there haven't moved up quite as fast as some of the smaller ones that have. So the value factor is actually bigger in that than it is in the even in that list that I just put out, because the stocks move so much.
Okay. Well, I was going to mention also that the home builders have had a nice run up as of recent. You wonder if I know you've always been very cynical as far as.
Well, I'd follow the trends on there. I can hear the music. That means I have to to run. But
Thank you,
thanks
Bill.
for calling.
Take
Yep.
care. Yeah. Bye bye.
And sorry I didn't get to the last caller. You can call me in my office if you'd like, 330-664-0700. Have a good week. The rest of you have good luck and good investing. This has been Bill Bullington on 1420 The Answer. I'll talk to you next week.
You just caught another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com. Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.